Good morning, everybody. Welcome, welcome.
Hey, Mike. Good morning. Hmm.
Good morning.
Good morning, good morning. Okay, we'll wait one more minute and we'll start. Hope you all had a good weekend. Um, I did. I was working all weekend. I need to take a little vacation, to be honest with you, but it's all right. We'll get there. We'll get there sometime.
Good morning.
Good morning. Okay, it's 10:05, so we're gonna start. I'm pretty sure there's gonna be a couple more people that kind of trickle in. But I think what we're gonna be talking about today is going to start up some good conversation. I hope so. You guys can feel free to chime in. But of course, we're going to start off with the kind of the market news from last week. We got some good news on the pending home sales. They've risen for the second month in a row from December to January. They climbed 8.1% from December to January, which is a huge jump up month over month. Now, pending home sales are basically the homes that are under contract on existing homes. Okay, this is not for new home sales. So pending homes went up, or pending home contracts went up at 8.1% from December to January. We're still down 24.1% year over year, but remember, these numbers are nationally, they're not locally. And that's still really good for, at least nationally, for those pending home sales to start increasing little by little. That did give us some good news on mortgage-backed securities for that day. That was late in the afternoon on Monday of last week, which is I don't know if it's weird, but it's not good that the bond market is so volatile based off of news that comes out every single day. People don't know if to buy bonds, sell bonds. It goes up and goes down depending on the news that comes out that day. That volatility is really what's hurting us. If you guys come here, to the Monday Mortgage Minutes weekly, that's really the biggest thing is the volatility that we're seeing in the mortgage in the mortgage space, or in bonds in general. Even with the treasuries. The Case-Shiller Home Price Index is finally out for December. And remember, this is the standard for home price appreciation that everyone uses, okay? We ended the year nationally at 5.8% appreciation. In such a tough year, we still managed to kind of pull out higher than average appreciation nationally. Not by much. And I honestly believe this year may be a bit lower than last year. Year over year, when we end this year, I don't think we're going to be at that 5.86%. We may be a bit. I think, in my opinion, 3 to 4% is where we're going to be in terms of appreciation this year, which is still normal. And as long as it's not negative, we will be okay. And those numbers are nationally, okay? Because locally in South Florida, we ended at 15.9% home price appreciation year over year, which is amazing. Tampa was in second place at 13.9%, and Atlanta was in third place with 10.4% home price appreciation year over year. So those markets, Florida market in general, is still really strong, and it looks like Atlanta ended the year really strong as well, surpassing all three of these markets, surpassing the national numbers. Initial jobless claims have been low, but continuing claims are still staying the same. So for those of you that don't know, initial jobless claims are people that are applying for unemployment for the first time. Continuing claims are people that are still on unemployment. And initial jobless claims, we thought that they were going to continue to rise this year, and they just have not been moving. The only thing that I can think of with continuing claims continuing to stay the same is that employers are not letting go of employees, but they're definitely not hiring. anybody new. There's a lot of a lot of job freezes, and maybe at some point those initial jobless claims will continue to tick up quickly. But as of right now, they've just been completely steady, or not fluctuating too much, but still have continuing claims. it would be more concerning, or not concerning, but it would be worse for mortgage rates if initial jobless claims were the way that they were and continuing claims were continuing to tick down. That means that people are still hiring and no one's firing. And to be honest, no one really expected this amount of volatility going into this year. Still, I know some experts had said rates could be in the fives by the first quarter, and rates did kind of dip their toes in it, but they've retracted ever since. I still believe what I've originally said, which is that we'll see probably be close to the fives continuously by mid to late this year, toward the end of the second quarter or third quarter. Once we have a full year of data that we're really balancing from last year, then we should see a little bit more stability, in my opinion, right? Because the data that we're receiving right now is still from the good times, right? Quote unquote, the good times when rates were much, much lower. Remember that shit didn't really hit the fan until May of last year, about late April, early May. So all of the data that we're getting now, January, February, March, even April, and going into May, is going to be compared to basically the previous market that we were in technically, on that year over year basis. So once we actually have a full year of the market that we've been in since last year, May, I think that we're going to start to see a little bit more stability, which is really what we need. And that, I don't know if it's going to help rates go down right around May or June, but it will help give some sort of stability within the market. And that, like I've mentioned to you guys in the past, is more important to me, because stability will bring people into the market, right? Low rates does as well, obviously, but when people kind of understand rates are going to be here, and they're staying here, then that's when you see people start to come into the market. Just like that original shock, right, from 3% to 6-7%, had a lot of people on the sidelines. And then once people realized, okay, rates are in the sixes, you started to see people come back in, and then rates got into the fives, and then had a whole bunch of people jump in. It's just about more so the stability than the actual lower interest rate, because consumers will get accustomed. A couple things. In the coming years, homeowners will be required to have flood insurance. Okay, I don't know if you guys know this, but they passed the bill, even if they're not in a flood zone. And I'll bring this up because this will be an extra cost for our buyers. Even though flood insurance is typically not that expensive, sometimes our ratios are so tight that extra $20-$30 $30 a month may throw some of our clients off. So just keep that in mind. I don't think it's going to really affect their budget, because their clients' budgets are usually whole numbers, $1,500, $1,600, $2,000, $2,500. So that extra $30-$40 a month, especially if they're not in a flood zone, I don't think that flood insurance would be very expensive. But it's something that, we can start letting them know that, hey, soon enough, you will be required to get flood insurance, especially if you have a Citizens policy. So Citizens is the one that's coming out first, that's going to be requiring people to have flood insurance. And we know that Citizens probably has most of our clients' homeowners insurance premiums right now. And then another thing, and this is because I was thinking about it actually this morning as I was kind of getting ready for Monday Mortgage Minute, and I did have a conversation with a client on Friday. If you guys voted during the midterms, you may remember that there was an amendment that stated we could authorize Florida to provide additional tax exemptions for frontline workers, which included teachers, law enforcement, emergency medical personnel, active duty members, and Florida National Guard. Believe it or not, the amendment did not pass. And I just was thinking about it today because of the conversation I had on Friday with my client. And I'm like, she's a teacher. And I remember voting on this amendment for frontline workers and voting yes. And I checked, and it had a vote of 58.58% of people did say yes. 41.39 said, or 41.19 said no. However, the amendments, they need 60%. They need a unanimous yes. So literally did not pass by like 1 point something%. And because of that, they're not getting that additional, I think it's about $50,000 off of their assessed value, frontline workers, in order to kind of get lower taxes. And the reason why I bring this up is because of assessed values on properties are increasing across the board, and clients' mortgage payments are increasing about $700 to $1,000 a month on just because of their real estate taxes, guys. This is a lot for somebody to be able to take on. My mortgage specifically went from 2,300 on my investment property to 3,300 in the span of a month. And I do know these tricks because I'm in the mortgage industry. I'm going to tell you guys what you guys need to do in order to, help clients that may come to you and let you know, because my client wanted to sell and I said, that's not a good idea. Worst case scenario, absolute worst case, if for whatever reason you can't afford it, rent it out, wait till November when those taxes become a little bit lower and it becomes more realistic for you to be able to get back into the home. And even obviously she wasn't happy about that, but I did tell her when she closing at 1,000 or 15, I don't know exactly what it was. It may have been like $1,800 a year in taxes. Your taxes will increase. I unfortunately cannot tell you by how much. I can't. If I tell you $700 to $1,000 last year, I didn't know that was going to happen this year, right? So I just give the warning, let them know they're going to increase and they may increase a lot. Okay. But now we're actually seeing it on my end. Mine's went up about $1,000 a month. Her mortgage went up $900 a month, and she's a teacher, right? She can't really afford it. So kind of what we do when that happens, and literally I did it as soon as I found out, is the reason why that payment goes up so much is because now the bank is technically double dipping, right? What happens is they were collecting, let's say, $2,000 a year in taxes, but that tax bill came in at $6,000 a year. So they're short about $4,000. Okay. Now that $4,000 is now considered that escrow shortage that now they have the client needs to pay that. But not only does the client need to pay that $4,000 escrow shortage, now the taxes are $6,000. So technically speaking, they're collecting $10,000 from the client in over a year in order for them to be able to catch up on the escrow shortage and pay their property taxes in November when they come back at that $6,000, right? So that's why that jumps up so much, because you're kind of double dipping on that escrow shortage plus the new property taxes. So what you do is you have the client tell the servicer, call the servicer or email the servicer, hey, I would like to extend my escrow shortage, but leave the maximum is 36 months. I would like to extend my escrow shortage 36 months. And so now instead of them collecting all the money in 12 months, they're going to collect it in 36. And that's going to alleviate about $200 to $300 a month for that client. And that's going to help them at least stay a little bit afloat. I mean, their payment still goes up automatically because their taxes increase, unfortunately, and they're still paying a little bit of that escrow shortage every single month. But it's going to alleviate some of that on the front end. And then just letting them know in November, what's going to happen is because you applied for homestead exemption, hopefully they did, because I know that we all told them to. If you did apply for homestead exemption in January, that's going to kick in November. So if the bank is collecting $6,000 a year in taxes, but that new tax bill comes in at $4,000, right? That $2,000 that they collected, one or two things is going to happen. If you already paid off your escrow shortage, you're going to get that refund back. If you didn't, it's going to go towards your escrow shortage and your payment's still going to dip down because now the bank is collecting less money for the escrow shortage and less money for taxes until your escrow shortage is completely taken care of, and then your payment will go back down to relatively normal levels. But from right now till November, they're going to be hurting, and usually till the end of the year, because even though that bill comes in November, those servicers are not really going to adjust it till December, January. So just keep that in mind with clients. Taxes are increasing a lot. And if I get that phone call from clients, which I've already had a few, this is the first one that tells me I'm going to have to sell because I can't afford it. It's $1,000 more, and I was not expecting that, or $900 more, and I was not expecting that. And I kind of told her what she can do, and she's going to be working on lowering the servicing. And luckily, she has an efficiency. She can raise the rent on a little bit, at least in the short term, to be able to kind of level out what she's missing. But these things are going to be happening to our clients more and more often, especially the ones that were really, really tight on ratios last year. Okay. I don't know if you guys have any news or anything, any input that you want to kind of come in with in regards to that. If you had a scenario, or if you overcame something last week. I can also tell you that I've been doing a lot of seminars this year for first-time home buyers. People want the information. First-time home buyers, they want to know what's going on in the market from you guys. So if you haven't thought about it, I know it's a lot of work, but if you haven't thought about trying to do one, try to set one up And it doesn't have to be you by yourself. You can do it with, a realtor friend of yours so that you can bring in more people into the room and have people invite different people. I definitely would recommend it for this year. Try to do a few because first time home buyers, they really want to know what's going on in the market, how they can get down payment assistance because they don't know where to go. They don't really know where to go, who to talk to. And they may talk to their cousin who has their real estate license, but is also, has a full-time job and doesn't really understand the market and the way that it works. So you definitely want to try to find ways to educate your clients. You don't want to do seminars. Like I mentioned in the past, video marketing is going to be a big thing for you guys moving forward. For your past clients, for your database in general, potential clients, new clients, get those leads in and start to work them and educate them on the home buying process because people really, really need it and they really want it. Most of the home buyer seminars that I've been to, they people come. It's not an empty crowd with 1 or 2 people. You get 10, 15, 20 people. That's a lot of leads for you guys in the future to be able to nurture and get them ready to start the home buying process. I don't know if you guys have any questions or any scenarios that you came across this week. No questions. Well,
I don't have a question, but I have a observation that I would like to share.
yeah,
I noticed that with the current buyers that are in the market right now, I call it buyer's remorse. And I know how the regular buyer's remorse is after you purchase a home, you're remorseful about the type of home that you purchased after the fact. But I feel like the buyers right now, they're remorseful that they did not pull the trigger when the interest rates was 2%, 2.5%. And they're looking at their friends and their family that, purchased homes, and the homes that they were able to afford looks way better than the homes that they're currently able to afford. So they're really hesitant and they're just not happy with the inventory that is out there. That is what I'm witnessing. So it seems like the focus that I have to focus on for my clients is to be able to make their purchase more pleasurable, meaning that they get down payment assistance. Basically everything you've been saying is down payment assistance, something that will make it better, make them feel better that they're purchasing right now, and compared to their friends and family that had to pay a lot of money for their homes. They're just not very happy right now. So this is what, as realtors, what we're going through right now, that we have a whole lot of pre-approvals. We just can't get them into homes because they're just not happy with the type of homes that they can afford.
yeah, and
I
that's
agree.
that's the conversation that I have with that I have with clients as well, right? I mean, and I always bring up the car example because it's true, right? Your first car wasn't your dream car, unfortunately, and your first home is going to be a stepping stone to the next one, right? We're not in the market where our parents were, our grandparents were, where they were able to buy a property very, very cheap and they were able to live in it for 30, 40 years, right? We are in a market where we're just going to have to take stepping stones, which is hard because we're also in a society of instant gratification, right? So it's kind of playing that with client or with borrowers and letting them know, hey, just because you're taking out a 30-year mortgage does not mean that you're going to live in the property for 30 years, right? You can live in it for 2, 3 years and then sell it, get that equity that you're going to gain and move on to the next one. Very similar to how you do with your with renting, except when you're renting and you relocate, you don't get any of that money back. So the benefit of you just starting now, getting something that you're going to be comfortable with because you need somewhere to live, right? There is no you can't be in a tent under the turnpike, unfortunately. You need to either rent or you need to either buy, right? And just decide which one which one you think is going to be the best option for you in the short term, which is most likely always going to be buying, whether it's in the short or the long term, because you're going to be able to get that appreciation. Just understand that your family member who bought at a 3% interest rate didn't tell you that they had to come in $20,000 over appraised value, right? They didn't tell you that they had to submit 20 offers before they got one accepted, right? These are the things that are pros and cons. Yes, absolutely. They're sitting on a lower interest rate, but you're going to be able to sit on a low interest rate in the coming years when rates come down, and your payment's going to be able to come down with it as well. And right now you're getting you have more flexibility with the house that you want. Last couple of years, people were just throwing in offers because they were running out of time. They were looking for 3-4 months. They couldn't find something. Their lease was about to renew, and they needed to just get into a home right away. So they just started to throw offers. I had a few clients that did that. Right. So talk to them about really the negatives of what happened in the market in the last couple of years, because you guys all went through it. Right. Yeah, it was great that people were getting pre-approved at 300, 350 and only had to pay $2,000 a month or $2,200 a month. But they also didn't get their offers accepted right away. They also had to pay over appraised value or waive their inspection periods in order to be able to get into the home. Right now, you're basically coming in with no money because a lot of sellers are giving money away. So now the opposite is happening, where you're not coming in with 20, you're actually getting 10 back. And then you couple that with down payment assistance, you're basically coming into the property with relatively no money. So that money that you did have saved can go towards fixing the house to make it how you actually want it to be, and make it your own. And then in a couple of years, once you've put your sweat equity, once you've built it up, and it's small because now you're going to be starting a family or whatever the case is, you sell that property, you make 40, 50 grand in 2-3 years, and you move on and you put that 40, 50 towards a property that you actually are going to enjoy, that's already moving ready for you. You don't have to do anything. You put in 10, 15, 20% down, and now you have the house that you've been wanting for the past couple of years. It's about, unfortunately, in this market, stepping stones.
Okay. So basically transferring their brains from instant gratification to gratification later on in life with their investment.
Correct. Yeah. They have to look at this as an investment, which a lot of first-time home buyers don't. Because if they did, they would have already bought their home a long, long time ago, right? So yes, they have to look at this as an investment. This is money. Your home is like your piggy bank, right? You're putting money into it every single month, when you're paying your mortgage or when you're upgrading something. You're adding value to your home so that when you sell it, it's worth more than what you bought it for. And there are studies, okay, that basically say that you always put in more money into your home, whether it's through mortgages or through upgrades, than you ever receive back. But we all know that rents are much, much worse because there's zero money that you get back, even though the landlord may help you fix the fridge when it's broken, and you don't have to worry, and you have to worry about that as an owner. You need to understand that in order for you to essentially build wealth and give your family something, you need to be able to invest. And that's going to start with purchasing your first home, right? You're not going to start that by living in a rental, or pretty much around the same thing that you would when you're purchasing a home.
Okay, thank you for your
No problem. You guys have any other questions or anything, or any scenarios or anything? No? Okay. All right, perfect. Guys, have a great week. This week, consumer price index comes out next week, inflation numbers. This week is the jobs report. If it comes in lower, we could see rates continue. We could see rates start the reversal again. They opened up good today from what I see a little bit, but we're still in the high 6s, low 7s for right now. Wednesday and Friday are going to be the jobs reports numbers, ADP and BLS. And then next week, consumer price index. If we see a big dip with CPI, we can kind of go back to what we were seeing a couple months ago, where we were in the mid to low 6s. Okay. But we'll cover that next week. Thank you guys. Have a good week.
Thanks, Mike.
Thank
No
you,
problem.
Mike. Bye.
Thank you.